Can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story that Fidelity is going to do the unthinkable. And with stocks sitting at their all-time highs and bonds rallying as the market believes the Fed is going to cut rates next year, I can't believe that Fidelity is about to do this, and you're not going to believe either. What's even more important is I'm going to show you why I think they got it wrong. And for an ongoing update on my health issues, be sure to check out my personal Facebook page where you might actually get answers to some popularly asked questions such as, does Steve wear lipstick? I just want to let you know I do love absolutely all of you. So stay tuned for more on that. But let's talk about what's going around the world, because as we get into what Fidelity is about to do, I need to set up some things. And to do that, well, let's start out with going over to Europe. As the Eurozone's rising recession risk fails to shift ECB on cuts. And this is a big issue here because we're led to believe that central bankers are data dependent. And what that means is they look at the data and they make some adjustments to the economic models, and then they precisely dial in where interest rates need to be to keep employment strong and inflation low. And yet, throughout history, they have a perfect track record of driving economies into a recession. And here we're seeing in the Eurozone, and particularly we talked about Germany, whose manufacturing sector is in a depression, that central bankers there are watching the data go down. And yet, there's no reaction. The chances of a Eurozone recession rose as private sector activity worsened, strengthening the case for interest rate cuts that the European Central Bank is so far resisting. Data on Friday showed the S&P Global's Purchasing Manager Index contracted for the 7th month in December, falling to 47, and that's defied economists' expectations for a slight uptick, with readings for manufacturing and services signaling a slump. Now, this number is based on the composite PMI, which is a blend of both manufacturing and services. Now, if we noted that, of course, the Eurozone manufacturing sector is following Germany down, and we have said that the services sector will follow manufacturing with a lag, and sure enough, about 2 to 3 months later, what did we see? The services sector starts to slow down. So a print of 47 suggests that the entire Eurozone economy is in a contraction. But is that enough for central bankers? Not yet. Such hopes are a bit optimistic and a bit premature, and as Mueller said, as a viceroy urged confidence and patience, saying the ECB is guided by data, not a calendar. And giving a date for the first interest rate cut goes against the principle of being data dependent. This from Portuguese Central Bank Governor Mário Centro, as he noted in Lisbon. And these comments chime in with President Christine Lagarde, who said Thursday that officials, quote, absolutely shouldn't lower their guard. And these cuts weren't discussed at all at this week's policy meeting, where the deposit rate was left at a record 4%. Now, many of you have noted in the comments, this is part of the central bankers' plans, that they wanted to over-tighten, that they want to drive the global economy into recession. And yet, what did we hear from the Fed just here on Wednesday is talks. And we're going to get into more of this because we've got some new comments now from the speakers here about perhaps there's a potential that we might cut rates into next year. Of course, I've made the case that what they wanted to do was slam the brakes on inflation, and they think by just letting off a little bit that they can achieve this mythical soft landing. But in Europe, they seem intent on just driving the economy into the ground. And here we can look in deeper detail. The French composite flash PMI. Again, remember, composite is a blend of both manufacturing and services. In December, dropped down to 43.7. This is in a recession. If you're under 45, you're talking recessionary print here. In December, of course, this decline was driven by both sectors, though largely skewed towards services sector, where the index fell to 44.3. So just as we predicted, we're seeing services follow the manufacturing sector down. And yet what's interesting to me is there literally is no reaction out of the central banks. Now, one of the problems, if you're kind of wondering how this works, is when you're data dependent. Well, you're not dependent on these surveys. You're dependent on government data. Of course, the problem with that, as we know, it's massively lagged. Looking at further detail here, we see the German composite flash PMI decreased to 46.7. Of course, that was below consensus. The deceleration was driven by both sectors, though skewed, get this, toward the services sector, where it's now in contraction at 48.4. And how about the periphery composite PMI, just of the countries around the Eurozone here? Now that's up to 49.4, driven by the services sector. So at least the peripheral countries saw a little bit of an increase, but notably that generally will not last. So what I want you to see here, as we're getting into the Fidelity story here in a bit, that demand in the Eurozone is slowing down. And so what does that mean in terms of its currency? Well, it means demand for its currency falls. Now let's head over to China now, where we continue this story and look for demand as China's gloomy economic data paints dire growth picture. Of course, we've noted that China's economy, perhaps nothing short of Germany's manufacturing sector, could be the catalyst for the next global recession and even kicking off a global financial crisis. While industrial output and retail sales expanded in November, according to official data, these numbers were distorted by favorable comparisons to a year ago when COVID lockdowns throttled activity. In reality, analysts said both measures of economic activity weakened last month when compared to more typical periods. Turmoil in the property sector continued to weigh on the overall outlook as indebted developers struggled to sell enough new homes. So even though the year-on-year comps look good, the problem is overall the picture in China is terrible. And we know that their economy, despite all of the stimulus that Beijing wants to pump into it, and guess what? There's more coming, isn't going to do enough. By numbers, they should have plenty in their population to drive internal demand. They can't do it. They're heavily dependent on the rest of the world. So as China continues to struggle, it just tells us the global economy, including the U.S. economy, is slowing down, which makes Fidelity's move to me even more baffling. It's very hard to see the economy growing significantly or people's confidence improving significantly. More needs to be done, apparently, just looking at how dire the situation is. And I want you to note here, what we see is this shift. You remember back when we talked about, China, putting controls on their property developers because the real estate market was just overheating. It was too much speculation, and Beijing wanted to clamp down on that. Well, they did. And now look at what we're seeing, a shift that there's not enough confidence. Well, why would there be? You look at Chinese consumers. You want to buy homes? Well, of course they're not confident. They're looking around and they're wondering as they see that their jobs are not seeing the workload that they used to. They know the global economy is slowing, and that doesn't bode well for them. You want to give consumers confidence? Well, it's simple. What do they want? They want a good paying job. They want to be able to pay their bills, and they want money left over due to inflation where they're actually able to spend and enjoy life. That's what it creates to give people confidence. In China? Well, in the rest of the world, a lot of people just don't have that right now. The weak data came as the People's Bank of China on Friday made the biggest net injection of cash via a one-year policy tool on record. That move will give banks more money to buy government bonds issued to support infrastructure spending. So not only do we have bank bailouts in terms of loans to banks to give to property developers, now we have cash injections. Again, we come back to the fact that China wanted to slow down their property sector. Well, Beijing yet did it. And now the problem is you've completely flipped to the other side. So this is interesting because we look at these extremes that policymakers go back and forth between, and yet what does everyone believe the Fed can do? Engineer the impossible that they've never done before. Again, this makes Fidelity's move a bit baffling, except under one absolute condition. We'll talk more about that in a bit. As analysts said, the injection decreased the chances of an imminent cut to the required amount of money banks must hold, a number known as the reserve ratio. Some also questioned whether the liquidity injection would bolster an economy battling downbeat corporate and consumer sentiment. Well, it can, but it may not work, and I don't think it will work at all. And again, this all comes back to discussing why do we see fiat currencies go down in value. Why is the yuan struggling? It's because there's a lack of demand. Now, when you start to understand the global economy is slowing down, one way to take advantage of this, and many people are struggling, they say, Steve, can I be a successful trader? I've tried to trade, it hasn't worked. Let me just show you how easy it is, because when we talk about currencies, this was a setup. Let's look back to this one. This was on November 6th. We're looking at our CTA Timer Pro report. Now, this mimics a machine positioning, and we told our subscribers, look, you can actually trade this. And we did this on the Sunday show, that if you want to trade the reversal of something, just wait till it comes off its longs. And here we see the dollar bullish ETF UUP come off its 100% long level, and we said that was one of two triggering mechanisms. Then we waited because we saw it coming off that level and said, look, wait till Momentum Timer Pro. This thing looks at all those technical indicators, and sure enough, it smooths them all out and had one minus daily count on the buy signal. And what this suggested is that you want to take a dollar short position. Of course, wait till you see what Fidelity is doing, because if you just traded the dollar, and this is how easy it is right now, you would have bought at open on that red candlestick. You would have taken a little bit of a loss, and then it took off, and just trading the short dollar, you'd be up 3.1%. Now, I put 3 coupon codes in the description below. You grab a 3-month for each of those reports if you're lucky enough. I'm doing that because I want you to try them. I want you to see how easy it is to be a successful trader, because like most of our subscribers, what you'll find out is when you start making money trading, these reports will pay for years of your trading research. All right, now let's go back to China, because their securities regulator is now asking publicly traded companies to boost dividends to reward investors, and said it will increase supervision of those who don't pay. So that's right, if you don't issue a dividend and put money back out in the economy, boy, we're gonna come in and inspect your books. Boy, that doesn't make a lot of sense, but just goes to show how desperate Beijing is getting here. But is that as far as they're going? Oh no, they went further. And they issued rules to ease conditions for company share buybacks. It also warned it would crack down on using buybacks for illegal activities, including insider trading and market manipulation. Again, we talked about how the Chinese stock market is struggling. It's going down because this isn't an issue of getting people just to buy stocks. It's an issue their economy is slowing down. It's contracting. That means stocks naturally come down. Of course, when that happens, the wealth effect goes away. People stop spending. Beijing desperate to get the stock market up. So we start looking at this from a currency perspective. We talked about the Eurozone. We talked about China. Why are their currencies weakening? Global demand is weakening. And that is what makes Fidelity's move here surprising. As Fidelity and JP Morgan buck market by betting on a stronger dollar, the dollar will surprise by getting stronger next year as the U.S. economy outperforms, according to some of the world's biggest money managers. So the case they're making here is real simple, that everybody else in the world, their economies are going to shrink and slow down and contract. And yet the U.S. economy is going to remain strong and robust. And because of the weakness of the other currencies, because again, they're all tied to the dollar goes up in value. Of course, that's not exactly how it works. It makes sense that we're in a global synchronized economy. So where the other countries go, the U.S. goes, and that's why I showed you the setup on that short dollar trade that I think has a lot more legs. Because Fidelity, JP Morgan, and HSBC are going against the consensus by warning of dollar strength, while Loomis Sayles says a global economic slowdown will see traders flock to the world's reserve currency. So which is true here? Well, we know if the U.S. economy slows, indeed demand for the dollar goes down. But yet there's just some peculiar thing that happens. Of course, when things slow down, the dollar shoots up in value. Let's start to understand why, because is Fidelity actually taking this as a hedge against a specific outcome? Or do they actually believe that the U.S. economy is going to stay robust as the rest of the world cools off? Here we can see the Philly Fed general business activity for the manufacturing sector. This in blue. So we're looking at the economy. That's why I wanted to go through the Eurozone and China's economy, because what do we see against the nominal broad dollar index, which shown in red, as the U.S. economy, noted as the manufacturing sector, cools off? Well, the dollar weakens. And this makes sense because that means demand for the dollar is indeed going down. And you'll see as the economy is picking up, well, the value of the dollar eventually goes higher. And then you can see as the economy economy cools off a bit, the dollar drops. We see that again coming out of the pandemic. We see that evidence now suggesting that indeed, as much as our reports are suggesting the dollar's going down, that there's actual evidence that it is right. And again, this makes it so easy for you to trade. Jump on one of those coupons before they're gone, because the handful of contrarian views are based on expectations that the rest of the world will struggle more with higher interest rates than the U.S. and lurch closer to a recession, suggesting the U.S. is immune here. Of course, we made the case that's not likely to happen. And while the Federal Reserve has indicated its plan to cut rates by up to 75 basis points in 2024, dollar bulls expect similar or even quicker reductions in other major economies from Europe to emerging markets, leading to wider rate differentials. So that's their base case, is even though the Fed's going to cut rates, that everyone else is going to cut faster. Now, why does this matter? Because even though central bankers do not have control over their currencies, well, the prevailing view is that they do. And so let's take a look at this chart, because what do we see? The dollar decreasing in value ahead of the Fed rate cuts going into the global financial crisis. Here you can see dollar losing value again ahead of the Fed cutting rates. We could see the Fed not wanting to cut rates after the surge in the dollar, and now we're seeing the dollar tend to start to fall ahead of the Fed rate cuts. But there's two areas I circled here, and that is these big surges in the dollar. Well, what happens then? Those are called financial crises, and that is the dollar becomes a flight to safety. So looking at Fidelity's position, are they suggesting that we're heading into a global financial crisis and they're buying the dollar as a hedge? Or is it the case that they actually believe that the U.S. economy is going to stay robust? If it's because they believe it's going to stay robust, I've got to disagree. I think Fidelity's got it wrong. If they're buying it as a hedge, well, I'm guessing they may be a little too early to the party. It's peculiar that the consensus think the U.S. dollar will be a loser in 2024. Well, I think it's going to be. A number of scenarios point to dollar resilience, but only a global soft landing delivers a clear bear case. No, it doesn't. An outright recession does. A global financial crisis is dollar bullish. And yet, Fed's Williams says talking March rate cut is premature. So if you're wondering why today the dollar popped up a little bit in value, well, not every time you see a Fed speaker comes out, it's because the market believes they control the value of the currency. And here we can see the Federal Reserve Bank of New York President John Williams said it's too early for officials to begin thinking about cutting rates as soon as March, as they consider whether policy is restrictive enough to get inflation back to 2%. So he's trying to talk the market back, who believes that rate cuts are coming as early as March. Of course, as we know, my belief is they are indeed coming as soon as March. What do you believe? Make your notes in the comments. Love to see those, as we aren't really talking about rate cuts. He said, well, even though they did, he noted it's premature to be thinking about cutting rates in March. Again, clarifying, we might cut rates by the end of the year, but not as soon as you think. And as Chair Powell said, the question is, have we gotten monetary policy to a sufficiently restrictive stance in order to ensure that inflation comes back to 2%? He says that's the question in front of us, suggesting that they're not entirely convinced, even though we know inflation is going to go blasting down through 2% and probably negative. And Williams said on Friday that, quote, the markets in a way is reacting very strongly, maybe more strongly than what we're showing in terms of our projections. Indeed, it's because the market is starting to believe, my friend, that you guys overdid it. You tightened for too much for too long, and now the markets see that you're starting to capitulate, except they know in history, you've been at zero once, then you were at zero twice. The statistical odds that you're going to be at zero again are really high. The market's priced it in. You got it wrong. And the evidence now, we look to the New York manufacturing sector. Here we have the Empire Fed manufacturing unexpectedly crashes into a contraction. So what could the market be seeing here? Well, perhaps it's one simple thing, that we got through that transitory boost from back to school and the holiday season. And now we're going to see the data, as we suggested, roll over. After three strong beats in a row, the Empire State Manufacturing Survey crashed back into contraction, going from plus 9.1 to minus 14.5. The drop takes a measure from expansion at 7-month highs to contraction at 4 months lows. And new orders. So if you look at demand for the dollar, we talk about the U.S. economy. Look at this. New orders fell 6 points to minus 11.3, pointing to a decline in orders for a third consecutive month. The unfilled orders index held steady at minus 24, a sign that unfilled orders continue to fall significantly. And after rising into positive territory last month, the inventories index retreated 14 points to minus 5.2, suggesting the inventories are dropping. And how about delivery times? Well, they dropped 10 points to minus 15.6, the lowest reading in several years, a sign that delivery times shortened. And the index for number of employees fell minus 8.4, its lowest level in several months, pointing to a modest decline in employment levels. And none of those things suggest that you will see a likeliness of a strong dollar until we have an all-out financial crisis and there is a flight to safety from investors all around the world. And that's what makes, in my opinion, Fidelity's move a bit shocking here. Weigh in the comments, what do you think? And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.